There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, traders, to the Memorial Day edition. Today is the 28th of May, last Saturday in May, coming into the final month of Q2 2022. My name is Steve Vetterl on the microphone here. I act in hopefully, a good risk manager capacity. So I try to do these podcasts twice a week. Usually use this period of time, just a little bit after 10 a.m. or a little bit after 1 p.m. Eastern time in both cases on Tuesday and Saturday to go through kind of what's going on in the markets in the last week, which, if you were not paying attention, was an absolute face ripper rally in equities globally, and a total reversal in the dollar against what was at least looking to be now some sort of blow off top or an island reversal. Maybe not the best pattern in both of those, but let me go ahead and share my screen. I also have a little bit of a piece for you guys here. I'm going to try and condense this down into just sort of a real quick presentation here, but let's take a quick peek at next week's Forex Factory first. All right, so as some of our overseas subscribers, and welcome again to all the new Auvoria Prime subscribers globally. Got lots of great stuff and presenters and educators and all kinds of stuff, and I highly suggest you be a sponge and learn from some of the best. So with that being said, and the shameless plug out of the way, Monday, May 30th is Memorial Day. So we recognize and our thanks to our country from all of our service members, both with us and up in heaven. We appreciate and thank you for your tireless work. So, in any case, Tuesday GDP. One thing I do want to note, if we look at last week, actually I'm not going to go back, but we had the PCE, which is the one of the main metrics the Federal Reserve looks at. The PCE indicator on Friday was actually down about 0.3 from what was expected. So maybe there's a hint of inflation pulling back from last week. But it's always want to take a closer look each month at that PCE indicator. Typically comes out towards the end of the month, and it is the main number that the Fed looks at from an inflation standpoint. So, looking into this forward week, get a fairly benign week because of the holiday. I would expect, seeing as though many school systems around the world, not all, are finished, at least they are in Florida, for the year. A lot of individuals that have been cooped up for 2 years essentially are going to be hitting the roads and the airways. So I'm already seeing a ton of activity here in Florida, just people looking to get out and do stuff. What's that mean? Why does that matter in risk management? So if you've been listening to my casts over the last 2 years, in the different presentations I've done, I'm always talking about risk management, right? So risk management is really just a culmination of all kinds of factors that can affect one's trading, right? And it doesn't necessarily have to be your education level. It could just be the volatility in the markets, right? It could be the lack of volatility in the markets. Well, why is that matter. You would think, hey, Steve, that's a less risk event. Well, if markets dry up in volume during holiday weeks, then games can be played by algorithms or any kind of high frequency trading system ripping through markets. And trust me, they exist in both the Forex, commodities, credit, and equity markets, as well as the futures markets globally. So don't fool yourself into thinking, hey, it's all smooth out there. At any given time with a lack of volume or certainly volatility, these types of systems are usually on the move, and they are looking to blow you out of your positions at a big loss. So just always keep that in mind when you're looking at a holiday week or any type of event where there is less volume. So ISM manufacturing, not as big of a deal. Obviously, the big thing coming into next week as a new month starts is the unemployment and the non-farm payrolls. This is really played second fiddle, quite frankly, as far as news-based metric indicators, because inflation takes front and center stage. This one has a significantly less impact. Also with the news this week, we have ADP, the non-farm, which is usually a bit of a hint. Do note the holidays here midweek. Actually, and I shouldn't say that. Note all of these holidays Thursday and Friday. So there is a chance for a lot of people to be on holiday, right? I know that's like a big term in Europe, so I think started saying it. We just call it vacation in this country. But on holiday, lighter volumes could lead to more volatility. That's really all I have to say in Forex Factory Land. Let's take a look at the charts. Finviz.com. If you've never seen this before, I show this trade each week. You want to focus on daily charts, weekly or monthly in some cases, as we've been surprised that we've had to go to monthly. Starting off with the indexes first. We can always look at all charts together. So here is the face rip. Again, daily chart. Each candle represents a single day. Face rip in equities, I would continue to see that. Actually, let me jump back, go to the S&P. If you haven't been paying attention, no big deal. I can give you a quick roundup of what's going on. In the S&P chart that you see here, we've cleared a really important level at 4,100, and now we're in what's called face rip mode. This is where all the knuckleheads that don't understand why you don't short a market like this at its such a late stage, especially with a number of reversal candles down here, are getting their margin calls in at this point. So the next level to clear is the big one at 4,300. If we clear that with significance, we're going to actually rally much higher. Surprising, right? We don't make it to 4,300, we're probably going to go back down and test the lows. Just an off-the-cuff chat on that. Not going to get too much in other markets, so I must say, really surprising to me, the outlier in this is the DAX index. I mean, if you take a look at where all markets are, and hell, let's look at this on a weekly chart just to make it easier, but look how, the U.S. markets of equities, whether it be small cap all the way up to the broader indices of S&P or the tech-laden based NASDAQ, not nearly, a lot more damage has been done here than in Europe. Isn't that surprising? So it's almost like it's broken away and maybe you want to rally. This is a great example of, not necessarily now, but historically, why diversification in global equities is important. I believe in being in developed markets. The emerging markets right now are a little more of a crapshoot, obviously, because Russia and China have killed most of those funds. That's why I do not believe in being in an emerging market or BRIC country-based funds as far as the equity diversification inside your portfolios. We do not invest in there, but this is certainly a great example of why just general diversification among developed equity markets globally is important, right? It's outperforming. Chart looks like crap, right? But it's the best of most evils right now. So we all know the heating oil space and the pain that has come to our pocketbooks there. I will not belabor that point. I do note that I find it very, very interesting that everybody, especially if you listen to all the realtors in the association organizations, they all have their analysts regionally in the U.S. By the way, as a just a side reference, and I know I'm going to piss a bunch of real estate agents off, but tough shit, because one of the worst type of directions you can follow is from a real estate analyst that works for the industry, right? If they're an analyst that works for somebody on Wall Street, great. But honestly, if the analyst works for any kind of real estate organization, they're always going to be telling you what markets in short supply, mortgage rates will probably go back down again. You need to get out and buy now. Prices are going higher. Those are the 3 or 4 core factors you always hear from these people. And in vast majority of the time, they are wrong, right? Why? Because they're biased. Somebody that is paying their, or I should say, signing their paychecks, has really only to benefit from the buying and selling of houses, period. So with that being said, maybe that canary in the coal mine here is the price of lumber. I talk a lot about this. Most people look at copper, obviously, as a designator, but look at the price of lumber. So if we were in such short supply and everybody and their brother um, was building a house, or developers or what have you, in terms of home developments popping up around the country, don't you think lumber would be priced be much higher? Think about that. That's low. What is lumber seeing in all of this price inflation? Now, maybe the Weyerhaeuser and all the big mills in Canada would say, well, they've just increased their production a ton, so the prices come down. Yeah, maybe that's the case. I haven't looked into it enough, but I find it interesting that if all these homes are skyrocketing in price and build, and yet if you've seen the charts from, again, the real estate guys, the homes being built are at the highest it's been since the early 70s. So there's actually more homes being built right now than almost any time in the last 50 years, damn near topping that high level. What's that telling you? At some point, there's going to be a mass amount of inventory coming on the marketplace. So if a ton of inventory comes on the marketplace in I don't care if it's art, classic cars, right? Tulips at the local nursery, what's going to happen to price? Typically that means price is going to fall because there's oversupply. So what does that mean for current prices of houses? And we've already seen it a little bit. We're getting a tick down in prices, but there is a gluttony of inventory coming on the markets. And obviously this is a regionally based discussion. Some may be more than others, but in Florida here, it's build city. So for those looking to buy a house right now, and I know the spouse that's probably going to hate this comment, I just wouldn't do it. I'd rather rent and wait for a wreck, and save 50 to 100K on a house, which more than likely is coming. So that's all I'll say in that area. So dollar big reversal. You can see how we reverse. I'm actually going to get into a little more detail on this in the drilled down charts, but I just wanted you guys to get a feel for this. It looks like I'm actually under the gun of a battery declining here. I wish I brought my charger. I'm a dope. So let's take a look at so reversal in bonds. For those of you that are sitting in lots of long-term bonds or certainly any higher yield stuff inside your 401ks, you're getting a little window to potentially lighten up on those allocations, folks. Just keep that in mind right here. The bell's not ringing just yet. All right, that's all I want to say there. Let's go into the charts. S&P for those trading EMT4 based. What do we just hit? See that? Just hit our first moving average. Notice it went right to it like a magnet. So just keep in mind that we've got, declining moving averages obviously here, but maybe this is best illustrated on a full screen. But we're up against, the center point, if you will, of volatility, which is what this line represents. And then there's the 3 moving averages here with the different colors, the green, yellow, and I guess burgundy red. Actually, let me remove this. My doodling. So this is the big level to watch for. It's the 4,300. It's probably going to magnetize this movement. Do understand that this move, while surprising to many, this is what's called a max pain move. I talk a lot about this. This is an interesting discussion always when it comes to the market's genuine desire to cause the most pain to the max amount of participants in the marketplace. So this concept of max pain, which you can Google, is always something that I'm hunting for, because usually it's going to manifest itself in the most people being blown out of ridiculously leveraged short positions, which there's absolutely no way I would want to be in that if I was any hedge fund that had any kind of leverage at all in the portfolio, you know? So the volume was lighter, obviously, because of the holiday, but this is an absolute rip. Doesn't mean it's going to continue on Monday. What the hell am I saying? Doesn't mean it's going to continue on Tuesday when the market opens back up. But just note that this certainly could be, and I think the price discovery has done, I don't know, a decent enough job down here that we're more than likely going to try and discover a price back up around this 4,300. The big money that's short, if in fact they do step in to defend or reload their short positions or add to, will be a real tell. I know that's far away from where we are, but that's we could be there in no time flat. Why? Because nobody's thinking about it generally, and those are typically the ones that have a much higher chance of manifesting themselves. So down to the DXY, no surprise again. Let's go to the full screener here. Big move is off of almost a perfect century touch at the 105, all the way back down to the mid ones. This is almost, not the best. But we had our first, if you notice on the dailies, our first support. We just finished above it. So there is a good chance, these lines are usually quite accurate, that we could spend some time balancing between this range trading some sort of sideways. So just note that. All right, Euro. So what does that mean for Euro-ness? Well, had really some ridiculously high volume here. May have actually put a floor in it for a period of time here at this 1.046 area. I was hoping this would go to parity with the dollar. That would be crazy. I think everybody's head would spin. It's where each has the exact same price structure as the other. A buck for a buck, or a dollar for a euro, I should say. But down here, note that in terms of the volume profile over this period of time, we have a couple of missing notches down here. So we got one right here, which is almost perfectly at that 104. So maybe in a much weaker period of time, the dollar starts to rally. We get back down to this 1.05 area. Missing notches. If you've never heard that term before, it really essentially is just a gap or an open or a missing piece of the puzzle in the actual auctioning process of price discovery up and down. That's what you see right here, which typically means we'll go down and try and fill it, which would probably be an excellent opportunity to go long. But I could be wrong. 1.07 seems to be capping us off at this point. Let's take a quick look at the other grouping of majors. Finished under this 1.2600-ish area. $124.75 on the bottom. Good support. Could be in a tight range. Again, we're looking at daily charts. Each of these candles is a single day. Ultimately, this is This is the scene of the crime right here. I would imagine at some point we'll go back up and test the scene of the crime. This is where you really know what a market's made of in terms of trading. This is probably a whole bunch of institutions that completely jumped on right here as we totally broke. And there was that beautiful slingshot, by the way. Another opportunity to get short for some sort of swing trade over a few days, or hell, even a day. The next day, you still would have had massive pips in that trade. It's good stuff. This is the beauty of these slingshots, by the way. Always be looking for them. Doesn't necessarily have to be developing as a chart pattern on a downtrend. Exact same thing can happen on an up. You got pain, right? You always get a little bit of a trade back or reversion to the mean, if you will. All this be kind of sloppy, but at some point, you can sort of reload the shorts for a hell of a run, right? You don't want to get too greedy because we had a number of indecision candles form at that point. All right, dollar Canadian. Looks like we're at some pretty solid support. Went right to it. Remember the complete over. I don't know. Probably easier to see this on a weekly chart. The complete and utter just rip. Call it an overreaction, if you will. Of course, I'm on a weekly chart. We still can't see. So this was the big resistance on a weekly chart perspective. We got all the way to 102 and then just blew through it. Sort of like you ran out of gas up here, and now we're coming back down, and we've just closed underneath that level, which tells me this may be an overkill. And this is a weekly chart. Maybe if we finish out, you know what? Let's try this. Go monthly on this. One of my favorite patterns is an island reversal on a monthly, which we never really quite got to, as you can see here. If this candle had opened up outside of this one, maybe went up and had a reversal, but it did the wick, came back down inside. Arguably, this was an open rejection reverse, but on a monthly perspective, right? So we open, we reverse. It was in a rejection reverse. Typically tells you with that type of pattern, it's going to cover most of the entire, it's going to essentially traverse all the way down to the bottom of that pattern if you have a rejection reverse. A lot of this is market profile terms if this seems confusing. I actually posted a piece on a Telegram channel all about market profile. All right, so I think we've covered the ones in mass. Take a look at GBP CAD. This is the NEO currency. Still holding that support on a monthly. Let's take a look weekly. Guys, it's holding. See that? Show a quick full screen. You minus a monthly chart. Holding the support. Peekaboo down here and it came right back up. All right, so let's take a look at daily. Not really much going on there. Tight range. Jump back to GBP. See how these charts look similar? Let's take a look at both. Looks like I'm under the gun here on battery life. So just brighten this back up. It's gonna hate me now. I'm almost done anyway. Right. No, I don't know where the hell my damn charger is. I may have left it in the office. Any case, let's take a quick look at crypto. Daily chart on the big move down. Still seems like we probably got lower to go to test down to that 20,000 level would be my assumption. All right, here's a surprise piece for you guys. I'm actually going to post this too. So I'm not certainly the author of any of these findings. There's been a bazillion out there that have done research on this, but the top 5 trades, and you can certainly Google this, of traders globally, of top traders, I should say, top 5 traders of top traders. Many of you will not be surprised by this, but the discipline, optimism, confidence, right? Patience. You always hear me talking about that. Many of the Auvorians are probably sick of me talking about that, but patience is a virtue, especially in trading. Searching for instant gratification or sort of hunting for immediate payoff almost always ends in pain, right? So the crowd will focus on complexity and try and reinvent the wheel. But the best traders focus on simplicity and improve what is known. And that is, in what is known can be very little, and that's why it's difficult in trading. There is no bell ringing at the top or bottom. You have to be able to deal with ambiguity. It's crazy important in the discipline. Discipline should almost say slash mindset, right? Think of a superstar athlete, one of the best in terms of just absolute killer focus that I found is a lot of women that have played tennis and different superstars throughout the years. My favorite was Martina Navratilova. I mean, her focus on the tennis course, just it's like Tiger Woods type focus, just in the zone, right? A lot of that comes from having confidence, obviously, but it also comes from having some knowledge on having the patience, but you're essentially in the zone. Believe it or not, yoga can actually help you inside the zone as well. There's actually a fair amount of YouTube channels that focus on mind control and sort of like, getting into the Zen. I mean, believe it or not, there's a fair amount of stuff out there that can actually totally help you on all that. So as the battery is running low, I will wish everybody a great Memorial Day holiday. My name is Steve Vetterl. May the trades be with you.
There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.